After 8 years of trading prop firms, over 1,000 individual payouts and $2.5 million taken from the markets in profit, I can tell you the single most important truth in this entire business. Risk management is everything. Your strategy barely matters by comparison. I know that sounds extreme, but I have watched traders with mediocre strategies get paid for years and traders with brilliant strategies blow every account they touch. The difference was never the strategy, it was the risk management. The strategy decides how often you win. Risk management decides whether you survive long enough for that to matter. This video is the complete risk management system I use across my entire portfolio. Every formula, every rule, every number. This is not theory. This is the exact system behind $2.5 million in payouts. I'm going to walk you through everything. Why risk beats strategy, the exact position sizing I use for CFD and futures firms, the risk to reward rule that makes me profitable even when I am wrong more than half the time, the daily rule that has saved me more accounts than anything else, how I manage risk across 10 to 20 accounts, why I never change my size even in a drawdown, and the recovery math that explains why protecting capital beats growing it. By the end of this video, you will understand risk at a level that most traders never reach, and you will see why the ones who master this are the only ones who last. Let me show you how risk management actually works. Layer 1. Why risk management beats strategy every single time. Most new traders spend 90% of their time on strategy and almost none on risk management. That ratio is exactly backwards, and it is why most of them fail. Here's the truth. A great strategy with bad risk management blows the account. A mediocre strategy with great risk management gets paid for years. I have seen this play out hundreds of times. Think about what a strategy does. It gives you an edge. Maybe you win 55% instead of 50%. Valuable, but that edge only exists if you are still in the game to use it. And that is what risk management protects, your survival in the markets. A strategy is how you win a trade. Risk management is how you survive the trades you lose. And you will lose, everyone loses. The best traders in the world lose 40-50% of their trades. The question was never how to stop losing. It is how to lose in a way that never takes you out of the game. This is why risk is everything. You cannot use any edge, no matter how good, if you have blown the account. A blown account has a win rate of 0 because it is not trading anymore. Survival comes first and everything else is second. So for the rest of this video, stop thinking about how to win more. Start thinking about how to lose less. That single shift is what separates the traders who get paid from the ones who keep starting over. Layer 2 is position sizing, the most important number you will ever set. This right here is the foundation of the entire system. Get this number right and most of your problems disappear. Get it wrong and well, no other rule can save you. I use different sizing for different firms. CFD firms give more drawdown room, so 1% lets me survive long losing streaks comfortably. On futures prop firms, I use a formula. I take the maximum drawdown and divide it by 8. If the drawdown is $2,000, like on a 50k account, my risk is $250 per trade. Here's why 8 specifically. It means I can lose 8 trades in a row before I am in real trouble. In 8 years, I have never really lost 8 trades in a row. The closest I have come was maybe 6. So the formula gives me a buffer that has never once been breached in nearly a decade. Most traders do the opposite. They risk enough to blow the account in 3 or 4 losing trades. 4 losses is nothing. Everyone has 4 in a row eventually. So they are not really trading. They are just waiting to get unlucky enough to get knocked out. Divided by 8 means the normal unavoidable losing streaks simply cannot end your account. Position sizing is the difference between a losing streak being a bad week or being the end. Set it so the worst streak you will realistically hit still leaves you standing. Layer 3 is risk to reward. How to be profitable while also being wrong. This right here is a number that lets you lose more than half your trades and still make money. Once you understand it, you stop caring about being right. My rule is pretty simple. Every trade must offer at least a 1 to 2 risk to reward. I risk 1, I aim to make 2. If a setup does not offer that minimum, I do not really take it. Here's why this changes everything. At a 1 to 2, you only need to win around 35 to 40% of your trades to be profitable. Let me say that again. You can be wrong 60% of the time and still make money because your your winners are twice the size of your losers, a handful of wins covers a pile of losses and leaves profit on top. Now compare that to a 1-to-1 where winners and losers are the same size. Now you need more than 50% just to break even after costs. You are fighting an uphill battle on every trade. That pressure to be right is what makes people abandon their rules. This is the freedom that good risk to reward buys you. When you know that one winner erases two losers, a losing trade stops feeling like a disaster. You take it calmly because the math is still on your side. Being wrong just becomes normal and expected. Now most traders chase a high win rate because being right kind of feels good. I chase a good risk to reward because being profitable pays better than being right. So 1 to 2 minimum on every trade. Layer 4 is the daily protection rule, and 2 losses and you walk away. Position sizing protects you on any single trade. This rule protects you from yourself across a whole day, and it has saved me more of my accounts than anything else. The rule, as you can see, is pretty simple. After 2 losing trades in a single session, I am done for the day. I close the platform, I walk away, and no third trade, no trying to make it back. Now here's why this matters. An account almost never dies from one trade. It dies from the chain reaction that comes after. You take a loss, it kinda sucks, so you take another trade too soon, too big to win it back. And that one loses too. Now you are emotional, and emotional trading turns a small bad day into a catastrophic one. The 2 loss rule breaks the chain before it even starts. 2 losses is the signal that today is not your day. Maybe the market is choppy, maybe you are not seeing it clearly. It does not matter why. The rule does not care about the reason. It gets you out before the damage compounds. And it works with your position sizing. 2 losses, a drawdown divided by 8 means you are down 2/8 of your buffer. And that is nothing. You can come back tomorrow at full strength. But 2 losses followed by revenge trading is how funded accounts disappear in just one afternoon. So set the rule in advance when you are calm, because the version of you that just took 2 losses cannot be trusted to make that call. 2 losses, just walk away and leave to trade tomorrow. Layer 5, never change your size, not even in a drawdown. This goes against what feels natural, which is exactly why it matters. Most traders change their size based on how they are doing. That instinct is quietly destroying them. My rule is the opposite. My size never changes, not after a loss, not after a win, not in a drawdown, not on a hot streak, the same risk on every trade forever. Here's why. When traders are losing, they do one of 2 things, and both are wrong. Some cut size way down out of fear, so when the winners come, they are too small to recover. Others increase size to win it back faster, which is how a drawdown becomes a blown account. Either way, changing size in a drawdown just makes it worse. It is just as dangerous the other way, right? After a few wins, traders feel invincible and always size up. And that is always exactly when the loss comes. Now double the risk, wiping out several winners at once. The market punishes those who have too much confidence. Now consistent size removes all of this. When every trade is the same risk, no single trade can hurt you more than any other. Your results come from your edge playing out over many trades, not from getting the sizing right on the emotional trades. You take the size question off the table completely, and with it, most of the emotional decisions that blow those accounts. Just use the same size always. It is boring and it is mechanical, and it removes you and your emotions from the entire trading equation. Layer 6 is managing risk across many accounts, the 1/3 rule that I use. Everything so far applies to a single account, but I run 10 to 20 to 30, even 40 accounts at once, and that creates a risk that most traders never think about, which is a correlation risk. Here's the problem. If I run 20 accounts and they all take the same trade at the same time, I do not have 20 independent risks. I have one risk 20 times over. If that trade loses, every account loses together. The diversification is just an illusion. My rule is the 1/3 rule. I never let more than 1/3 of my accounts be exposed to the same correlated risk at once. If I run a setup, it goes on at most 1/3 of the portfolio. Now why 1/3? Because even if my worst correlated trade goes completely wrong, only 1/3 of the portfolio takes the hit. 2/3 is untouched. The portfolio survives easily and keeps producing. One bad correlated call can never take down the whole operation. This is the difference between having many accounts and having a portfolio. Many accounts all doing the same thing is just one big account pretending to be diversified. A real portfolio spreads risk, so no single event, no single bad trade can damage more than a controlled slice of it. If you run one account, file this away for when you scale. But the day you run more than a few, this becomes as important as position sizing. Never more than 1/3 exposed to the same risk. Now layer 7, the recovery math. Why protecting capital actually beats growing it. This is the layer that makes everything click. Once you see this math, you can never look at the big loss the same way again. Losses and gains are not symmetrical. This is the most important and least understood idea in all of risk management. Here's the actual math. You lose 10%, you need 11% to get back to even. It's not terrible, but watch how fast it gets ugly. Lose 20%, you need 25% to recover. Lose 30, you need 43%. Lose 50%, you now need to make 100%. You have to double what is left just to get back to where you started. Now read that again. 50% loss requires a 100% gain to recover. The hole gets exponentially harder to climb out of the deeper it gets. This is why big losses are so deadly. It is not just the money lost, it is the extraordinary gain now required just to get to break even. This is the entire reason my system is built the way it is. Small sizes, the 2 loss rule, consistent sizing, the 1/3 rule, everyone exists just to keep those losses small. Because a small loss is easy to recover. 11% to recover 10% is nothing. But let a loss get large and the recovery math turns against you so violently that most traders never make it back. So protect your capital. Keep every loss small. A trader who never takes a big loss will always beat a trader who takes big losses and tries to win them back. So let me bring the whole system together again. Risk beats strategy. A mediocre strategy with great risk gets paid. A great strategy with bad risk blows up. Survival comes first. Position sizing, 1% on CFD, drawdown divided by 8 on futures. Set it so a normal losing streak can never really end you. Risk to reward, 1 to 2 minimum. Be profitable while being wrong 60% of the time. The daily rule. 2 losses, just walk away. Break the chain before it becomes something really bad. Consistent size. Never change it. Remove yourself from the equation. The 1/3 rule. Never more than 1/3 of your portfolio exposed to the same risk. And the recovery math. Small losses are easy to recover, but big losses are almost impossible. Just protect your capital above everything. Here is the truth that ties it all together. I did not reach $2.5 million in payouts by having the best strategy. My strategy is pretty simple. I got there by never really blowing up, by surviving every losing streak, every bad day, every drawdown, and staying in the game long enough for a simple edge to compound into something pretty big. That is what risk management really is. Not the boring part you get through to reach the exciting part. It is the entire game. The strategy decides how fast you grow. Risk management decides whether you are still there to grow it all. Just master this and you will outlast almost everyone in the trading game. That is what 8 years and 1,000 payouts have taught me. Risk is absolutely everything. Now, if you want me to help you build this risk system into your own trading, I run a mentorship program called the Profit Blueprint. I do not work with everyone, but if you are serious about lasting in this trading business, apply through the link in the description. And when you are ready for a firm that actually pays fast, I recommend Hola Prime. They have the fastest payouts in the industry, an average under an hour, but usually 10 minutes payouts with a zero denial policy. You can also use the link in the description for that. Thank you guys so much for watching. See you in the next one.